Okay, so let's now move on to the next part of our program. Uh, to give us her views on the local market, let me introduce or call onto the stage our Chief Equity Strategist, Miss April Tan.
Hey, good morning, everyone. And thank you for attending our market outlook briefing. Okay. So I'll just, jump right into my presentation. And I guess, as an investor, I think these are the two most important questions in everybody's mind, no? With the Philippine market already up by 8% and outperforming global markets, including the most Asia-Pacific markets, and performing in line with the strength of emerging markets. First of all, is this sustainable? If I had not yet bought, am I too late? I think these are the two most important questions that need to be answered today. Okay, I think it's important to discuss first why markets went up, to understand whether or not it's sustainable. And, there are some fundamental reasons for it. It's not really, just by some stroke of luck. Because most importantly, inflation, which was one of our major problems last year, and I remember talking about this during the 2018 outlook, that's one of my key risks. And it really was a major pain last year. You can see how finally inflation has gone down from a peak of 6.7%, which is the gray line here. From a peak of 6.7, it has gone down to 5.1% in December. And the two major drivers, which are transportation and food, you can see how they've gone up very much significantly previously, are also falling down. Okay, they're no longer problems. And I think another important thing to highlight is core inflation. Okay, core inflation measures inflation outside of volatile food and oil prices. And you can see, although our headline inflation peaked at around October, our core inflation still continued to go up. However, finally in December, it also went down, which is really very good. This is something that the BSP really looks at. And when they see core inflation going down, then that's much better. Okay, and why is it relevant for us? First, you can see how interest rates have gone down. I mean, for us as analysts, we don't really, we look at the BSP rate hikes, but at the same time, we also try to see what the market is saying. And based on the secondary market or the longer term bonds, that's how the investors communicate. And you can see how interest rates have gone up all the way to 8% at one point in time. It started at 5.1% during the start of 2018, went up all the way to 8%. Now a 300 basis point increase is very significant. Can you imagine? It's almost a 60% increase in effective interest rate, no? And then it has gone back down to 6.5%. And the reason why lower inflation is good is because it means potentially an end to the central bank rate hikes. Remember last year, the central bank increased rates by a total of 175 basis points, which is really a lot. And the BSP might also resume cutting reserve requirements. So banks right now have to set aside around 18% of deposits as reserves, and they cannot lend this out. And last year, the BSP actually already cut it by 2 percentage points. Originally, it was 20%. They brought it down to 18, but they stopped it when inflation was very high. So this year, they may resume cutting it. Later on, I'll discuss why this is very important. Okay, another reason why falling inflation is good is because, consumer confidence is really at a very low level. Okay, just to put things into context, last year when, I remember last January when prices of everything went up, I think the feeling was, people didn't like it, but they were thinking, well, since I have a higher pay because of the income tax cut, I don't have a choice. Because of the tax reform program, I need to pay for it. So I'll just suck it in and, pay for it. But this year, people are just so fed up with higher prices, such that, even if I kind of felt like this January, some retailers still tried to increase prices, but the reaction wasn't the same because you don't have that confidence. They call this nga the animal spirits, the confidence to spend. People don't have it anymore. They just don't want to spend. They're just fed up. Like, okay, you increase prices, I'm just not going to spend anymore. So that's essentially what this means. This is the relevance of it. Consumer confidence has dropped to a very pessimistic level because of high prices. So what's good about inflation not going up anymore is it will help this confidence return and people will finally start spending again. Okay, so I think the relevance of what Dr. Paul Kitney talked about a while ago is about what's happening globally. Last year, high inflation was compounded by negative global developments. But this year, we're seeing a reversal of what's happening globally, and this is also good for us. Okay, first of all, slower global economic growth means lower commodity prices as represented by the CRB index. And I think the most relevant to us is falling oil prices. Okay, so that's helping us. This is good for us and good for corporates in terms of improving margins. Then you have the US dollar. So I think it's not very clear in here, but if you look at where it was at in December 2018, it was still very strong. But you will see there's a slight weakening in the US dollar. Okay? And, that's helping the Philippines because, well, it's not very clear here. I think they got the wrong slide. But you will see how there is an inverse relationship between the relationship of the index and the US dollar. Every time the peso depreciates, the PSEI weakens. Every time the peso strengthens, the PSEI also strengthens. So there is an inverse relationship between the two. Okay, and of course, a slower global economic growth or the prospects of a slower growth would mean a pause in the US Fed rate hikes. And as discussed by Paul a while ago, this would mean a reversal of what happened last year, which is, the outflows from emerging markets. So last year, it wasn't only the Philippines, but all emerging markets were out of favor as the US dollar and US assets seemed the most attractive because of higher rates, strong dollar, strong US economy. So now we're seeing a reverse of that. And for the month of January, we're not even over yet. We've already seen an inflow of 12.6 billion pesos. Versus last year, you can see we were consistently being sold down by foreign investors except for the month of January. And this is very important for us. Okay, and then we started the year, valuations were very cheap during the start of the year. We were trading at 15.6 times PE. Okay, historically, we were trading between 16.5 to 18.7. That's around 80% of the time. We're trading at that range, no? Okay, so the average is around close to 18 times. Okay. And even, so for those who are purists who want to use a 10-year average, we just looked at each and every index constituent during the start of the year, and you will notice that except for a handful of companies, most index stocks were trading at a discount relative to their 10-year historical average PEs. Okay, so it was a very fertile ground for the markets to go up during the start of the year. So there really was some basis for the strong performance of the markets. Okay, but that said, although I'm positive, I think I have been very vocal about how I feel about the strength of the market. We feel that the upside will be capped. It's not going to go back to 9,000, at least in our opinion, or to sustain above 9,000. And for these reasons, okay, I'll talk about them one by one. First is the twin deficit. There's still going to be problems for us, and this will cap the peso's ability to strengthen and interest rates to decline. Next, growth of investments and government spending could slow down this year, limiting the ability of GDP growth to hit the 7% target of the government. And finally, slower global economic growth could hurt exports and remittances. Okay, so our end 2019 PSEI target is only 8,600, which is below the 9,100 peak that we saw in 2018. Okay, so first I'd like to talk about the twin deficits. So this is one of the problems of the Philippines that has been widely talked about by a lot of investors, and one of the reasons why they're avoiding the Philippines. Okay, first is the budget deficit. Okay, as you can see, our budget deficit has been ballooning, and this year it's projected to hit around 3.2%. That's the forecast for this year. And the government has said that it will remain at the 3% level because they want to build infrastructure. They want to expand their spending on infrastructure, improve infrastructure, which really is much needed for the Philippines. There's nothing wrong with that. And of course, our current account, which measures dollars coming in versus dollars coming out, you can see that previously it was at a surplus. It's positive. We have more dollars coming in than dollars coming out. But you can see that starting in 2016, it turned negative, and for the first 9 months of the year, it was negative 2.7%. And for 2019, the BSP is saying they're expecting it to be around negative 2.3%. And the reason why we're having this is because there also is a lot of importation of capital equipments necessary for the Build program. So, in other words, these deficits are going to stay in 2019 and maybe even 2020. And they're not good for the peso. Okay, if you have more dollars going out than coming in, the natural tendency is for the peso to weaken. Okay, so it helps that the US dollar is no longer strengthening, but the ability for the peso to strengthen like it did in the early 2000s, I don't think is there anymore. Most likely, we will still be at around this level going forward. Okay, interest rates. Well, I think these are the factors that we should look at for interest rates and also investments. Okay, as you can see, bank lending rates have gone up quite significantly last year. So this is based on BSP data. The average in 2017 was 5.6%, and for 2018, it's 6.1%. Okay, but if you look at the end 2018 average lending rate, it's at 7%. Okay, 7% versus 5.8%. So that's a big increase. So if your lending rates are much higher, investors are, I guess, more turned off to invest, or some projects will be shelved because your lending rates are much higher, no? And, banks' positions right now, they are less liquid, not in a position to keep rates low. I think anecdotally, for everybody who places time deposits time deposits today, time deposit rates today are so much higher compared to early last year or late 2017. So that's an indication because banks now don't have a lot of money to lend out, which is why earlier on I talked about the reserve requirement cuts being very important because it will allow the banks to lend more money to borrowers, no? So liquidity conditions aren't good. We feel like interest rates are going to go up because of the twin deficits, or at least interest rates are not expected to collapse. It's expected to remain high because of the tighter liquidity conditions and the twin deficits. And this will discourage investment spending. And for the government spending, although the budget, I think they're projecting an increase of still double digit this year. I think I'm a little bit worried because of two things. First, there's the delay in the passage of the 2019 budget. Okay. So at the earliest, it will be passed middle of February. Okay. And there's an election ban. So the release of public funds will be suspended from January 13 to June 12. And the relevance of it, the government will be spending based on a reenacted budget. Therefore, there will be delays in new projects and spending will most probably be weak. And you know, that said, so I just like to point out that in the past few years, the spending growth of government and spending of investments have been faster than GDP. They have actually helped drive economic growth for the Philippines. And the share of those two have already gone up to around 35% of GDP. So they're now big contributors, unlike before, they were very small. So may impact yan kahit paano. I'm sure you've been reading newspaper reports quoting economists saying also that they're not confident of the 7% target this year. Probably we'll still see around the same level of growth we saw in 2018. Okay, and then for exports and OFW remittances, in the past we've always been resilient. As you can see, the orange line has always been going up straight. Even during the global financial crisis, there was no slowdown. We were never affected by it. But you know, this time around, I'm just a little bit worried because you can see how we have kind of matured. We have peaked. Previously, you see growth of more than 10%, but now we're at the 3-4% range. So that just means we're now a little bit more sensitive to slow down in global economic growth. So that's something I'm watching out for. Okay, other risks that could happen. Okay, tighter global liquidity conditions. I guess the question is, you know, if I were to look at any indicator right now, what should I watch out for? You know, one of the major factors causing our markets to reverse or to rally is the reversal of global conditions favoring fund flows to emerging market Asia, including the Philippines. So I'd watch out for news indicating global liquidity conditions like Fed rate hikes, you know, maybe bond buyback programs in other countries, including Japan, Europe. Okay, so any indicators like that. Worse than expected global economic slowdown. So I think a lot of economists are anticipating slower growth this year. But then if growth is actually even worse than what they're expecting, then maybe we could see weaker markets. And finally, we're now seeing some share placements happening that could continue to happen throughout the rest of the year, and that's not good. Typically, when there's an announcement of a share placement, share prices initially go down. Okay, sector outlook. So I'll start out with the sectors that I like for this year. I like the banks and consumer stocks or consumer sector. So we like the banks this year because we feel like the margins are going to improve. because of higher rates, they'll be increasing their, repricing their loans. And the deposits, of course, because they have savings and current account deposits, those will not be repriced. So essentially, the margins will improve. Trading gains should improve also because last year was a um, poor environment for trading. And there's a possible reduction in reserve requirements as discussed. The only negative is you may see slower loan growth this year, but then the positives we feel will outweigh the negatives. For consumers, lower inflation should boost consumer spending as discussed earlier. Election spending, this year is the midterm elections, and typically midterm elections mean higher same-store sales growth as people buy more products given the campaign spending. Okay, lower costs due to the falling commodity prices, that should help margins improve. The only negative is that a lot of the consumer stocks have gone up and are now very expensive, especially the large cap ones. Other sectors that should benefit this year include the cement sector. Demand is expected to continue growing this year because of the Build program and also because of the private sector construction spending. And then just recently, the DTI imposed a safeguard duty on imports. That's an additional 4% tariff taxed on imported cement. So making local cement more competitive. And finally, lower power costs. So power accounts for around 45% of cost of goods for cement companies. So that's another plus for cement companies. Airlines should benefit from the more stable exchange rate and falling oil prices. Okay, so dollar-denominated costs account for around 60 to 70% of airlines' costs. Okay, these other sectors are a bit more mixed. For properties, it's mixed. Residential sector outlook not so good because amortization rates are now higher or more expensive because of the higher interest rates. But then the outlook for rentals like offices and commercial remain very strong. You still see the BPO sector growing, especially with the weaker peso today than a few years back. So we're still seeing them come in. Gaming remains very strong. Okay, even the traditional businesses locally are finally picking up, requiring more office space, and there's tight supply of offices. For commercial, the same thing. Right now, what's popular is restaurants. They're taking in more restaurants are opening because going to malls now is more of a lifestyle thing for people. You don't go to malls to shop anymore nowadays, and so it's a bit mixed for properties. We prefer more rent-oriented property companies. For power, it's not very good because there still is an oversupply of power generation. Okay, so the only benefit is at least the cost of coal and oil is now lower for them. And for telcos, it's a little bit mixed. There's strong demand for data. It's really picking up, growing by double digits. Competitive environment has improved. Globe and Smart are now more friendly towards each other as their market share is a little bit even already. Problem is the legacy business is still a big chunk of revenues and it's still acting as a drag. These are text messages, phone calls. They're still declining and dragging the profits, and high capex spending because of the strong demand for data. So telcos have to spend, and poor sentiment because of the third telco. Okay, these are a summary of my stock picks. Okay, so I will just be discussing the new names that I've added. So you can see in the consumer sector, I've added two new stock picks, Maxis and SSI. And then a play on Airlines, Cebu Pacific. CHP, um, well, we've switched out Eagle and added CHP, and I'll be discussing why I like it in a little bit. Okay, Maxis. So Maxis has a new management team, and they implemented some changes, which allowed profits to recover already last year. First quarter, the company had bad numbers. Second quarter, third quarter, it was very good. Um, so for this year, at least we expect EPS to grow by 16%. So these initiatives will continue to gain momentum aside from the factors benefiting consumer sector. And the stock is trading at 12 times PE, which is very low for a restaurant because the peer average is around 24 times. And in the past, Maxis had traded at 21 times PE. KSSI also, last year it was suffering from the weak peso because it was afraid to increase prices, although imports were becoming more expensive. But finally, they have increased prices, and the stable peso should help them. Aside from that, the company has been undergoing a store rationalization program, and that has already been showing signs of greater efficiency in terms of lower operating expense to revenues and lower inventory days. Valuation-wise, the stock is trading at 10 times PE, below its 5-year average of around 14 and a half. And then Cebu Pacific, okay, it's a major beneficiary of falling oil prices and stable exchange rate. Okay, for this year, we're projecting revenues also to grow by 17% due to its fleet expansion, and earnings or EPS to grow by 50%. And the stock is still very cheap right now. It's trading at 5.9 times EV EBITDA, below the peer average of 7.9 times EV EBITDA. Okay, CHP, I think this is a little bit controversial. Last year, CHP had a lot of bad luck. It had a lot of problems. For example, it was affected by the write-off of tax assets, and then the suspension of the operations in one of its kiln because of a landslide, etc. Okay, but those issues have been resolved. The suspended operations are now online again. Okay, and then the pricing power of cement companies should improve with the safeguard duty on imports. As I've said, it's equivalent to 4% increase. Okay, so because of that, from only 86 million in 2018, we're projecting profits to finally reach 1.2 billion. And I think the most important, or for me, the main reason why I think this is going to rebound is because valuations are crazy cheap. This whole company is trading at a market capitalization of 12 billion pesos. So just to put things into context, 12 billion pesos versus Eagle, which has a market cap of 80 billion, more than 5 times. Okay, so a 12 billion peso company for such a size, no, and big market share is really very cheap. So we're targeting conservatively 3 pesos. I think it should reach there. It's just that, for me, CHP is, might not be the best company, but I think because of valuations, because of the recovery story, it has a good chance of being a good stock. So sometimes bad companies can be good stocks and good companies can be bad stocks. So CHP is more of a not so good company that is a good stock. So I think we also include our buy below price here. you might be wondering, what's this buy below price? Because sometimes we like some companies, but they are just so expensive. And, you know, as of assuming that you come out here and on Monday you want to buy something, what stocks can you buy? If I look at the buy below price, here's the short list of stocks you can buy. And I know you can also buy CHP and others, but you know, we were discussing if you were only to buy 5 stocks, which should you buy? And for me, these are my favorites. Okay. Well, yeah, you can also buy CHP, but I think, you know, I trade it more because, of course, I'm a little bit worried. The track record hasn't been the best. So, yeah, I think a lot of investors also feel the same way. They're not very confident about the company. So, yeah, and also about the small companies, maybe just be a little bit more nimble and limit your size because they tend to be less liquid. Okay, and assuming that the market continues to go up and you have, you know, there usually when the market continues to go up, there's a rotation to value. These are the other stocks that we like: MPI, FPH, AGI, China Bank, PNB. Okay, you will notice that in these, the first 3 are holding companies. Kasi usually investors like to buy direct plays. The holding companies tend to be, you know, last priority when the underlying companies are already expensive. Then they switch to the holding companies. So for the banks, I said banks will benefit this year. So if the big banks become already very expensive, or the traditional favorites become expensive, there will be a rotation also to the other less liquid banks. So this would be PNB and China Bank. So with that, thank you very much. I'll be talking more later. Thank you.
Thank you very much, April.